Hello, ladies and gentlemen. Welcome to this presentation where we'll be tackling the section B of the ACCA financial accounting paper. Okay, this is a mock test, and some of the questions have been adopted from the past exam questions from the ACCA website. So we are going to, you know, just use that publicly available information as part of our revision. And I guess by the time you are watching this video, ladies and gentlemen, you are preparing yourself for the upcoming ACCA financial accounting real examination. Okay, so this is part of your preparation, and some of you have attempted this paper with us, and you have scored well, while others have been struggling. But I guess this is going to be something that's going to assist you in your preparation. Okay, dizoere madara. Yeah, some are saying, oh, mdara wakanyanya, and urikurova, urikuponda, which is something we need, okay, because there should be some value for money. You mustn't just pay a tutor who is just doing nothing, who is not adding value to your studies. Okay, so ladies and gentlemen, without much ado, let us go straight to section B. Okay. Okay, this is the question, ladies and gentlemen. Question Keswick. Okay, question Keswick. All right, let me try to zoom in to see if we can see the question clearly. I mean, zooming out. Okay, yeah, I think you are now in a better position to see the question clearly. All right, so that's question Keswick. All right, and this question can be downloaded from the ACCA website, or you can just Google it online. You can find this question. All right, or in some of the revision kits. Okay, revision kits like the PPP revision kit, you can find this question. All right, those who feel like they also want to benefit from these tutoring exercises, you can get in touch with me on the numbers on the screen there, or let me just annotate them. Okay, this is the name of our school, Transcal Business School, and these are the numbers. You can contact us on WhatsApp, okay, or even a direct call, or you can also use this email address. All right, now the question is saying Keswick acquired 80% of the share capital of Dwent Co on 1 June 20x5. Summarize draft statements of profit or loss for Keswick Co and Dwent Co for the year ended 31 May 20x6 are shown below. Okay, so those are the financial statements, the draft financial statements. Okay, and this first one, okay, this first one is what we call the statement of profit or loss. That's the draft. Okay, now during the year, Keswick sold goods costing 1 million to Dwent Co for 1,500,000 at 31 May 20x6. 30% of these goods remained in Dwent Co's inventory. So whenever you're given a consolidation question, you must ask yourself, what was the group structure? Here we are told that Keswick is the parent who acquired 80% in the subsidiary Dwent. So 80% was acquired. Therefore, the NCI was 20%. Okay, the NCI was 20%, the non-controlling interest. All right, now we are given the statement of profit or loss there. All right, and our number one task, okay, task 1, as the question says, you need to use the information to complete the following financial statement. So you must use that the information provided in that draft statement of profit or loss to complete the blank spaces. Okay, so this is our task. We need to complete to give answers to these blank portions. Okay, you need to give answers there. Now, this is a consolidation question, and by consolidating, it's usually you have to add line by line, but you also need to incorporate some adjustments. All right, so for example, we are told that during the year, Keswick sold goods to its subsidiary. Okay, so the parent sold goods to the child. The family did not make any profit there and there. It only makes profit if the child subsequently sold those items to external parties. So the right hand can't say I've made profit when it sells goods to the left hand. It doesn't work like that. So in the group of, in the view of the company, if the two companies which are under the same control sell goods to one another, no profit is being made unless those goods are subsequently sold to external parties. All right. So in this case, we are told that 70% of the goods were sold, but 30% were still in inventory. Okay. So we then have to ask ourselves, what profit was made when these goods were sold? Remember, they were costing 1 million. Okay, they were costing 1 million, but they were sold for 1.5 million. So the profit that was made there was 500,000. Okay, 500,000 was made as profit. Now, what is 500,000 of the cost? 500 of the cost was 1 million. So 500,000 over 1 million, it means the profit was 500 over 1 million. So this means the profit or the markup was 50%. Okay, so you need to tell yourself that, oh, so the markup was 50%. So we need then to worry about the provision for unrealized profit within the 30% of the goods which are remaining. 30% of the goods were still in stock. So we are saying 30% of 1.5 million. 30% of the 1.5 million was still in stock. So what is 30% of 1.5 million? This is 450,000. So 450,000 worth of goods were still in inventory. So what is the profit element in this 450,000? What is the profit element? Okay, we know that the markup is 50%. So the profit element in this is actually 450 multiplied by 50 over 150. Why? Because we want to know, this is the PEP we are talking about, the provision for unrealized profit within the 30% inventory is actually going to be 150. These are your workings. You just have to know these workings before you start to attack the question. All right. So you have those figures. You then have to then start to attack the question. All right. Remember, the provision for unrealized profit is actually going to affect our cost of sales. Okay, the cost of sales is going to be increased by that provision for unrealized profit. Okay. All right. So we then have to start answering the question. All right. Now, okay, let me first wrap this off. All right. Okay, so we're going to say for the revenue we are going to use the figures as provided. Okay, this one we're going to take it 8.4 million plus 3.2 million. Okay, we're going to take those figures, but we also need to deduct the 1.5 million. This 1.5 million, which was the amount which was charged when goods were sold to the subsidiary. Okay, we are saying that that is not a sale. Okay, that is not a sale, so it has to be removed. So we are going to say for our revenue, we're going to say 8.4 plus 3.2 minus 1.5. Okay, so what is the figure? Let us use our calculators. So that's 10.1. Okay, 10.1. Okay, 10,100. Okay, or remember the figures are in millions, so that's 10,100,000. Then on the cost of sales, the cost of sales, we are going to say 4.6 plus 1.7, okay, plus 1.7. But remember, the 1.5 million which was charged by the parent when the goods were sold to the subsidiary should also be deducted. Why? Because it's not a cost of sale, because that was not a sale. Okay, so we need to deduct that. So, and then we need to add this 150. Okay, the provision for unrealized profit has to be added to the cost of sales. So we are going to have, please mind my space. There's no space there to write. So I want you to follow me clearly. Hey, Seron, I want you to pay attention. I'm saying 4.6, all right? The 4.6 here, 4.6 plus 1.7 minus 1.5, okay, plus 150. That's our cost of sales. Okay, 4.6 plus 1.7 minus 1.5 plus 150. That gives us 4.950. And this 4.950, remember, is in brackets because these are costs of sale. Okay, so it's a figure for cost of sales. All right, that's a figure for cost of sales. Okay, so if we deduct that figure from 10.1, we are going to have a gross profit of 5.150. This is 5.150, which is the gross profit. Okay, then we then have to less expenses. Okay, these are now the expenses, the operating expenses, admin expenses, and so forth. All right, so the expenses now. All right, so let's start with the distribution costs. All right, the distribution costs, we're going to add the cost for the parent, 1.5 million, and the cost for the subsidiary, which are 510. So this gives us 2.01, 2010 as our cost. All right, remember these are costs, so therefore they should be in brackets. Please do not make a mistake of adding, of only taking the 20%. Remember, the new standard says that once control is achieved, therefore the performance, the performance information is going to be taken 100% of it. So we are going to add the 100% of it. All right. Why? Because this subsidiary was acquired at the start of the year. 1 June. Remember, it was acquired on 1 June and the year end is 31 May. So since we acquired it at the beginning of the year, therefore we take the 100% of it. But if we had acquired it during the year, then we were going to time apportion. But in terms of consolidation, the percentage acquisition is not going to be a worry when it comes to consolidating the line items. You just have to take 100% of it. However, if it has been acquired during the year, then you have to time apportion. Are we together, ladies and gentlemen? Okay. Now, administrative costs, you just have again to take across. Okay, to just add across 1.5 plus, I mean, this, okay, it's 700 plus 450. That is actually 1050. I mean, 1150. So that's 1150 in brackets. Okay, then we go to the profit before tax. Okay, profit before tax, you just have to ensure that, remember, this was our gross profit, the 5, you can start from there. Okay, that's 5150 minus 2010 minus 1150. Okay, that's 1.990. All right, then less tax. All right, the tax, you just have again to add across 600 plus 140. That's 740 in bracket. 740 in bracket. Then you get your profit for the year. Okay, so that's profit before tax 1.9. Remember, you can underline here. You need to underline here. Okay, then 1.990 minus 740, that gives us 1250. 1250 as the profit for the year. 125. This is a 5. It's not a 3. It's a 5. 1250. Okay, so this was the profit for the year. Okay, you can just double underline as the profit for the year. Now you need to then appropriate this profit to the owners of the company, or the majority shareholders and the non-controlling interest. All right, so how do you do that? Okay, first you need to know how much profit was attributable, I mean was made by the subsidiary. Right, you then have to then use that one as the starting point. So the subsidiary made a profit of 400,000. All right, but there were also non-controlling shareholders in the subsidiary. They are there, the 20%. Okay, so we determined that the non-controlling interest was 20% according to our group structure computation, which we made at the start of the lecture. So we are going to say 400,000 multiplied by 20%, and this is going to give us 80,000. So the NCI is going to get 80. Right, so we are done. And then once we know that the NCI has obtained 80,000, then the remainder should go to the parent, and so that's 1250. This 1250 minus 80. 1250 minus 80. So the equity owners of Keswick are going to get the balancing figure there, which is 1170. Okay, if you add them, if you add these figures, this one and this one, you must get 1250. If you don't get 1250, then your answer is wrong. Are we together? So I've just put that figure just for elaboration. It's not necessary anyway. Okay, what is required by the examiner with those two figures? All right, then let us do part 2. I mean, the task number 2, to see if we can ask the question as well. Does each of the following factors illustrate the existence of a parent subsidiary relationship? So you are just going to use those factors to establish if there is a parent subsidiary relationship. So the examiner is testing your understanding of the consolidation theory. All right, so number 1, 50% of all shares and debt being held by an investor. 50% of all shares and debt being held by the investor. You need to then stand on the theory of consolidation. Okay, so if one holds 50%, or let us just say, okay, there were preference shares, there were ordinary shares, there were a lot of shares which were involved, okay, in this particular company, in the capital structure of this company. All right, but does that make somebody a parent if you own all, I mean 50% of all the shares? Okay, that does not necessarily establish a parent. Okay, all right. There could be some joint venture, or it could be an associate relationship. Okay, so the having 50% alone is not enough. So the answer there, you were supposed to tick no. Then, greater than 50% of the preference shares being held by an investor. Preference shares are usually considered as debt. Okay, they're usually considered as debt. All right, so they do not. So if the examiner is not specific, okay, because we've got two types of preference shares. We've got irredeemable preference shares and redeemable preference shares. All right, so if the shares are redeemable, then they are considered debt. If they are not, then they may be considered as equity. All right, so the examiner is not specific there. So if he is not specific, therefore, then we can't say again. Uh, if that clarity is not given, therefore, please just consider them as um, a red herring. Okay, the statement is not clear, so therefore, it is safe to say no. All right, the examiner has to be specific. Which type of preference shares is he referring to? If you are having greater than 50% of, again, you also need to remember that preference shares, all right, they can't be technically considered as voting shares. All right, so by the end of the day, if if you own 100% of the preference shares, okay, let's say they are irredeemable, but they are also equity shareholders on the other side, then you are not the parent. Okay, you're not going to be the parent of that company, right? Because the owners of the company are equity shareholders. All right, so even if in terms of IFRS 9, the irredeemable preference shares are considered as equity, all right, that alone cannot give you the parent or the control that is given to the ordinary shareholders. So in that, based on that argument, you can't say owning more than 50% of preference shares makes you the parent. Okay, so the answer there is no. Now, control. If there is control, therefore there is a parent uh, subsidiary relationship. So the answer there is yes. Okay, because uh, what makes a company a parent and a subsidiary is actually the acquisition of control, and you need to acquire more than 50% of the equity shareholders. Okay, that's the I mean the primary uh, evidence. Okay, that's the primary evidence. Once you acquire more than 50%, yes, you actually become the parent. Although there could be some certain contracts which might limit your limit your exposure or your exercising of the right of being a parent. Okay, there might be some limitations which are imposed by certain contracts which might limit your powers, and you might be restricted to act as a major shareholder even if you have got more than 50% of the shares. Okay, the standard allows that. Then, okay, if I say the standard, we are referring to IFRS 10. Okay, consolidated financial statement, and IFRS 3. Okay, business combinations. These are the standards which govern these consolidation issues. All right, don't worry about those. Okay, for now, concentrate here. Now, what about if greater than 50% of equity shares being held by an investor, yes, there is a parent subsidiary relationship there. 100% of equity shares being held by an investor, 100% equity shares, yes, then there is also a parent subsidiary relationship. Sometimes you acquire 100% of the subsidiary shares, sometimes you acquire more than 50%, and in those cases you are also going to be considered the parent. What about if there is significant influence? If there is only significant influence, that is somewhere around between 20 and 50% of the shares, then there is an associate relationship. This is an associate, so the answer is no. Then where there is non-controlling interest, if there is non-controlling interest, it's like if there is if there is control, okay, if there is control, then automatically there's a subsidiary, and when there is a subsidiary, there's also there could be some NCI, some non-controlling interest, somehow if the control was achieved but not after acquisition of 100% shares, then therefore then there was some NCI somewhere. So if there is an NCI, automatically there should be some uh, parent subsidiary relationship. So the answer is yes. Okay, you can't have NCI when there is no subsidiary. It doesn't work like that. Okay, when there is NCI, so therefore, if you're an auditor and they've arrived at a company and they are saying that there is some NCI or there is a ledger account speaking about a non-controlling interest, so therefore you then have to ask yourself, so where is the subsidiary? Okay, there should be some subsidiary somewhere. Right, so you need to ask the papers of that acquired company. So there was a parent subsidiary relationship when there was NCI. Then greater than 50% of preference shares and debt held by the we say that this was a no. So this was how you were supposed to have answered this question. You can see that these are very simple questions which can be passed even if when you didn't revise thoroughly. Okay, so see you in the next question when I'll be explaining the workings required for that particular question. Until next time, please continue to feel very excited. Like I said, if you feel like you also need a tutor, these are my numbers. Okay, these are my numbers, and this is my email. You can send me directly your emails so that I attend to your queries. Until next time, may you continue to feel blessed and strong, because ACCA needs require a lot of ACCA needs you to have a lot of stamina so that you ask these questions outstandingly. Okay, outstandingly. Thank you very much. Goodbye.